Hi, everyone. Welcome. Today, we're going to study a company that I'm fascinated with, and that is Shopify. We are going to take a look at their business model and see how they make money. We will move forward to corporate governance and see where the power lies. And then we're going to take a look at the valuation and see what would be the fair price if you were going to buy this business. So what's Shopify? Shopify unifies all commerce into one single platform. If you want to manage your day-to-day activity of your business, you need to start on paper with pen and pencil or move forward to a spreadsheet, or you could have a software or a platform that could manage your day-to-day activity, which would be from inventory, receivable, payable, placing orders, billing customers, invoicing, and so on. So that's what Shopify provides. They provide a platform where you can manage your day-to-day activity of your business and run your business. How did it start? The founder, Toby, wanted to sell a snowboard through his own business. When he was trying to set up the business, he find out, well, he needs an ERP system. But the ERP providers out there, which stands for Enterprise Resource Planning, which could be like SAP, Oracle, Sage, there are many of them out there, but they usually suits for medium and large corporations. For small businesses, it's very difficult at the time. It was very difficult to find any provider. As a matter of fact, it was impossible, not just difficult, because there was no provider. So Toby identified something that is in demand, but there's no supply for it. So he decided to build his own version of Shopify to run his business. Later, after launching it, using it, he figured out not only can he use it for his own, but he could actually sell this product because there are many other people out there who needs this, but it's just not supplied to them. So how can you commerce over the internet? There's really two ways that you can transact or buy goods and services. One is you do it directly with the producer, or you do it through a dealer, a middleman in between. Think of it if you would go to Lego store. You could go to Lego store directly and buy toys for your kids, for instance. On the other hand, you could go to Walmart and buy the exact same toy from Walmart. In this latter, Walmart was a middleman, which facilitated the transaction. It's the same thing over the internet. You either go to www.someonesstore.com and you buy the goods or services over there, or you might go to Walmart or Amazon, which they would facilitate a transaction for you and be the middleman and collect some, commission in between. Shopify business model is the first version that we just discussed. So it's direct with the consumer. So think of it as a virtual store that you would set up over the internet. It's not physical, but it's set it up over the website, and you conduct business with the consumer directly. It's not just Shopify who provides that platform. BigCommerce, BigCartel, WooCommerce, Squarespace that comes very close, or Magento. These are all competitors that are trying to provide e-commerce for direct to consumer. They have all their pros and cons. I do some due diligence by watching YouTube videos that merchants were sharing their experience using these platforms. And it's pretty interesting that I came across a lot of merchants who were saying Shopify is the best ones. I actually had I had a chance to interview one of the merchants myself to get their point of view on this product that Shopify offers, and they were so happy with it. They all of them, there's a pattern that I've been seeing is it makes it as easy as possible for them to run the business, and they could be focusing on developing the business. So that's really the value proposition that Shopify has. If you look at the company from the very beginning, from its birth through now, you would see it's been constantly innovating, introducing new features and functionality to merchants and to the consumer, to the buyers, to facilitate the transaction, to make it happen. The most new one that's been in the news, it's the fulfillment. So Shopify is setting up their own warehouse and logistics system to actually take care of the delivery of the product. So in that form, the merchants don't have to ship the product to the consumers. They can stock the product at their warehouse, similar to Amazon. And when the order comes in, Shopify is going to package it, ship it to the consumer. And your job as a merchant is making sure your product is stocked in their warehouse. So let's look at their Shopify competitive advantage. They are building the company with the mindset that making e-commerce to happen, their prices are extremely low to be as competitive as possible, but not losing money. So reducing the price, the revenue share, as low as possible to make it easy on e-commerce, on the merchants to sell their product online. Their innovation, as we saw in the previous slide, remains their competitive advantage. Some of them include Shop Payments, Shop Pay, Shopify Fulfillment Center is the big one, and Shop Apps and Shopify Capital. The risk and opportunity in this business, I put together in form of scaling from 1 to 5, which it's subjective in my opinion, the 1 being the lowest, highest being the 1 being the lowest, 5 being the highest in terms of risk and opportunity. In terms of risk, I see Oracle, IBM, or SAP, launch their own ERP version for small businesses. Well, we haven't seen it yet, but there is a chance. You can't deny the probability in there. Amazon could decide to share some information about consumers with the merchants, which is unlikely to a good degree, but they could share to some extent. Not all of it, but to some extent. So that would erode some of the competitive advantage as Shopify has, because Shopify is about building the brand, and Amazon could erode that to a little bit, but not fully. The one thing is operational risk that I saw in their 10K, which Stripe is their vendor that provides their payment processing on Shopify. So if anything happens to Stripe, if they go down for a few hours, a couple of days, or something like that, all the merchants will be running into trouble. They cannot process payments. So that's a very concentrated dependency, if you would say, from Shopify to Stripe, and which exposes all the merchants over on their platform, which is about 2 million now. So that's an operation risk. In terms of opportunity, there's a lot of services could be offered online. Most of the commerce is about goods, consumer goods, mugs, for instance, headphones, hats, those the tangible products. But accountants could offer their services, attorneys, they could offer legal services, engineers, they could offer consulting services, and so on. So it's there's a lot of potential that as we progress in the next 10-15 years, those businesses could be more frequent and more often as we see it today in 2022. So that's a good opportunity. they could, provide a search engine to suggest which merchants would be a good fit for a need for a consumer and make money by receiving commission from driving consumer spend to merchant. So that's something that might be very probable, in my opinion. That would be another avenue for Shopify to drive revenue to the merchants, and as a result, they take some of it as a commission, perhaps more than what they do now, and that would be another avenue. Then they could sell their own product on Shopify. It's very unlikely, but it's not impossible. It would be equivalent of Amazon Basics brand. In terms of corporate governance, Toby and John, the director, John Phillip, these two individuals hold 9% of the equity out of the company. And that will account for 73% of Toby's net worth and 62% of John's net worth, based on the search that I've done. The rest of the insider is about 1%, not really significant. What it tells me, they are not playing with house money, with their own money. They have substantial skin in the game. So that means they are most likely careful and take calculated risk. On the other hand, what you should know, the Class B shares that they do own have 10 voting shares, as opposed to Class A, which has only one voting per share, one vote per share. That translates to these two individuals controlling more than 50% of the company. It means theoretically, if you bought all the shares outstanding right now, and if you wanted to change anything in the management, you cannot. It's their votes. So if you buy all the outstanding shares, whatever they decide, that's how the company is going to be run. Good and bad, it has its own pros and cons. We can get to it a little bit later in a few slides. Looking at the addressable market, the consumer e-commerce from consumption, which is goods and services together, if you sum this up, in the United States, it accounts for about 6%. Before pandemic was about 4%, a little bit more than 4%. China is the biggest market, $2.8 trillion of e-commerce, and US comes next with about $850 billion. These figures are based on end of 2021. The addressable market for Shopify, they've been taking market share in the United States from 4.7 in 2018 to 5.9 in 2019, 8.6 in 2020, and 10% in 2021. The mix of the revenue, this is how it looks like. They have about 64% of their revenue through US and 35% internationally. The GMV is gross merchandise volume. This is the collective amount of transaction that took place over Shopify's platform across all merchants. So think of it this way: $175 billion worth of transaction took place, and Shopify made $4 billion and $611 million off of that. That translates to 2.63% take rate or revenue share, which Shopify puts it as, for every $1 that we made, our merchant made $38, but that's really translates to 2.63% revenue share take rate. Looking at Shopify monetization, the take rate, the revenue share from 2016 started with about 2%, and it's been growing to 2.6% now. So you see that progress. And if you want to look at it from the GMV lens, that would be the chart on the right, which was from 50 to 38. It means they've been monetizing better and better and better. Now, looking at the retention of the merchants. This chart summarizes the amount of revenue that took place by the merchants who joined on 2018 or prior years, in the dark green, and those people who joined in 2018 or prior in 2021 were making most of the money, and that pattern holds water from 2019 to 2021 and from 2020 through 2021. This I can interpret two things. First, Shopify is sticky, and two, those who remain on the platform tends to build their business and become successful. And that's what you really want to see in a successful business. A slide that summarizes the fundamentals of the company. On the left side, on the top, we see the revenue on the trailing 12 months on quarterly basis. Then the pink or the yellow line, they represent the gross profit ratio on quarterly and trailing 12 months basis respectively. The green and purple represent the operating income. The operating income that I'm presenting here are adjusted for R&D. And the way I do it, for every 3 years, I add back the R&D expense, but then I amortize the R&D expense that took place over the past 3 years. So basically, I'm capitalizing R&D to take account for the real expense of R&D that was relevant to that period that the revenue was earned. And my estimate is about 3 years for Shopify. Some merchant stats: 2.1 million merchants on the platform as of now. It's been growing from 243,000 all the way to 2.1 million from 2015. And as you see, the subscript for every merchant, they used to make about $461 in subscription revenue. Now that figure is about $651. So not a drastic change. Some growth for sure. But the real driver of the growth was the merchant solution revenue. That's the Shopify payment. So the more they sell on Shopify platform, the more Shopify makes, because that they don't collect rent, if you would say, they collect some portion of your revenue. So that number has been growing and growing, which tells me where the growth is coming from. It means that it comes from the success of the merchants. If they make money, Shopify makes money. The gross profit margin across subscription revenue and merchant revenue is a bit different, drastically different, actually, as a matter of fact. The subscription, which is the monthly fee they collect, the gross profit margin on that is 78%. I mean, it was volatile a little bit between 70 and 80, but pretty constant on high 70s. However, the merchant solution gross profit margin started from 27%, was low, and then it's been climbing up all the way to 43. With them getting to fulfillment, this trend is not going to continue, and as a matter of fact, it's going to be reduced, because fulfillment and logistics is a high capital intensive with low operating margin. It's not like software that you can have, high operating margin, and we're going to get to that slide. But the mix remained in a way, as this portion of the business, the merchant solution revenue, was becoming more profitable, and the volume was going up. The mix remained around 55, which is pretty interesting to me. The chart on the top shows me that the blue line represents the revenue on quarterly basis, and the blue charts represent cost of revenue divided by the revenue. It means how much of the revenue that they brought was associated, how much was the cost of revenue for every dollar that they brought in. So hypothetically speaking, for every dollar they brought in, they spent 49 cents on the cost of revenue, which would be, for instance, the data centers or the direct cost that was associated with that revenue. The SG&A is the salary or the vendors that they have, the people that they've hired, accounts for compensation, and so on. And then the blue, the green one, represent the R&D amortization. And what I can see here, it means as the revenue was going up, the cost of revenue remains intact. So if the revenue goes up by 20 folds, the cost of revenue is going to go up by 20 folds. However, the SG&A is not growing proportional with revenue. As revenue goes up, they don't need to hire as much as headcount as they would. So what it tells me, if revenue goes up, if they grow, they gain economic of scale and they become more profitable. And that's where the operating margin will be. That's where the operating margin will manifest, will get large. So that's the rationale behind letting the Shopify going from 9% operating margin to some other number. So what that number would be? Well, that's the billion-dollar question. If I look at Amazon operating margin was about 11%, and all of these numbers are adjusted for R&D on 3-year basis. On Oracle, SAP, or eBay, or CRM, Salesforce, I mean, they vary from 11 all the way to 20 or 39, if you would say, for Oracle. So I need to find out where Shopify would be. Shopify is very close to Amazon, if you would say, after setting up their fulfillment center. So the way I would think about it, it's Shopify is going to be somewhere between a software company and a logistic company. Well, software company, pure software company would be such as eBay or Oracle. So they would be in high 20s or somewhere in like 30s or so on. And if it's going to be a logistics company, we'll have to pick a number around less than 10%. So depending what portion of revenue associated with each segment, then that's where the aggregated operating margin of Shopify will be. Right now it's at 9%. So I am thinking this number will be somewhere around 16%. We'll have a slide that will walk us through that logic. Now, the sales to capital ratio, it means for every dollar that they invest, how much money they will bring as a revenue. Because the growth doesn't grow on tree. They need to reinvest back to the business in order to grow the business. So for Shopify, before getting to fulfillment, as you see, the sales to capital ratio was high. It means for every dollar they invested, they were bringing $2.17 in revenue. Similar to Amazon, as it got more heavily involved in logistics, the sales to capital ratio has been going down. For me to pick a number around sales to capital ratio for Shopify, I'm okay with the number about 120. With fulfillment numbers, if you would see, like logistics company like FedEx, Hub Group, UPS, these numbers in far above 150 or sometimes above 2. So that's, I think 1.30 is a good mix. So what story am I telling about the valuation of the company? The e-commerce is not either Amazon or Shopify, but it's both. They both complete the picture. Shopify will be remaining the top 3 choice for merchants, entrepreneurs to start their business online. Shopify fulfillment will be the next driver to grow their revenue and bring merchants to the platform and make e-commerce possible. The GMV will be At the core of this business, the take rate is really the base, the core of the business model. So the more GMV, the more revenue for Shopify, the more packages they're going to be shipping, and so on and so on. So the other thing I'm betting on is I'm putting in my valuation is they're going to find more ways to monetize the platform. Could be through advertisement, could be through launching their own store, commission that we talked through. We talked a little earlier about launching a search engine and so on. So yeah, I would think they can increase the take rate by providing more value to the merchants. And I can see based on the track record of company that they've been constantly innovating and providing more value to the merchants and consumers. The other thing I would point out in my valuation is from corporate governance point of view, Toby and John controlling more than 50% of the company is a double-edged sword. One, they're not playing with house money, with their own money, so they take calculus risk. The other part is they could make a decision with good intention that will result in a bad outcome. And in an event where there would be someone to balance his power, that scenario would be absent. That could be a stupid acquisition. That could be hiring a lot of people because he thinks the pandemic hump will be permanent, and then finding out down the road, oh no, we have to let 10% go. I don't know if I could be sure if someone would oppose to that opinion if Toby was making that decision, but since he has all the control in the company, he not all, but majority of the control in the company, if there was someone who wanted to actually vote against that decision to ramp up hiring, he had no chance, or she had no chance. So you have to be okay with that being in your valuation story. That's how this company is being run. It's not good or bad. It's just there, and you have to be okay with it. How am I arriving at what revenue Shopify will be having? Well, as I said, there will be two segments that Shopify will be making money. It's about the take rate and the fulfillment. The take rate, so how am I getting there is first of all, I start from the world GDP. I project the world GDP based on the real growth rate of economy and a little bit of inflation that it has about 3%, 3.3 or 4 roughly per year. And I get to about $116 trillion worth of GDP. As of 2021, 6% of all the recorded transaction in terms of GDP was taking place online. That translates to about $4.4 trillion. And Shopify GMV was 1.75. It means Shopify worldwide had only 4% market share. Now I'm going to estimate that consumer on e-commerce will be growing from 6% to 8.4%, 5%. And Shopify market share will grow from 4 to 5.5. And that will translate to GMV going from 175 to 460. I also assume that they're going to find more ways to monetize the platform, which means the take rate will go from 2.63 to 3.52. That will translate to $16.2 billion revenue in merchant and subscription solution. Then based on what we saw in SAP and Oracle, I'm going to assume their operating margin going to go from 7.5 to 33.9, almost 34%. However, I also going to assume about fulfillment segment. The fulfillment segment, I'm going to assume every $60 would translate to one package. So that 175 billion divided by 60, that would be about the number of packages they have to ship. For every package, they're going to bring about $11 as revenue. And that $11, 6% of it will translate to EBIT, which is operating margin. And over time, it's going to go to 10% based on what we saw in logistics company. So when I do the math, I aggregate these two numbers from fulfillment and subscription and merchant solution revenue. I arrive to a number around 15%. And that's over the next 10 years. The valuation thesis from a different lens is just, I'm not going to look at the world GDP. I'm just going to grow their merchant numbers from 2.1 to 8.3 million. So it's going to go up by fourfolds. Subscription solution revenue going to go from 650 to 1,400. Merchant solution revenue, including fulfillment, going to go from 1,500 to 8,000. We saw the gross profit margin on the previous slide. I'm going to assume the subscription remains intact. However, the merchant solution is going to go from 44 or 43 to 37.8, which is about 5% decline because of the fulfillment. And when I aggregate these numbers together, I'm going to arrive at about 16% operating margin. And the revenue that I have is at 77. So very close to the other lens that I was looking at. So this one summarized the story that I just said, line by line. What would be the GMV in 2021? What would be the milestone in 2027? And this is Nirvana, where we're all going to be celebrating if Shopify gets there. So what's going to be the equity value in this company? Well, due to the slowdown in economy that we are perhaps seeing, I increased my valuation in years, like my story from 10 years to 13 years. So Shopify is going to be having $78 billion revenue in 2035, in 13 years from today. So they're going to grow from 5 billion to 78 billion. This is, if you see this 77 billion here, it's because it's the next year number. They're trailing 12 months, it's almost $5 billion. So that requires about 40% growth. I'm going to let them to grow at 40% for the next 3 years. Then I'm going to reduce the slowly, reduce the growth rate and assume it's going to be a mature company by 2035. The sales to capital ratio is going to start from 230 to 123. And as they, get a scale, it's going to increase a little bit. So it's go to 135. So that's how I can compute their investment, how much they have to reinvest back to the business, and how much going to be the free cash flow to the firm. And then I compute the present value of the free cash flow based on risk-free rate plus beta times equity risk premium. Equity risk premium assuming 5.8%. And the beta of the company unlevered, I assume 1.35 as of today. And I will slowly reduce it to 1.1 as the business gets mature and becomes less risky. So that's my story. The value of operating asset that I get is about $30 billion, adding cash and subtracting debt will give me the equity value of $37 billion. There are 126 million of shares outstanding in form of Class A and Class B. If you assume Class A and Class B have the same price, that will translate to $30.13 per share. Stock is trading about 32, 33 these days. This is August 24 of 22. So it's 10%, 10 to 12% overpriced, but it's volatile. On a weekly basis, it moves around 10 to 15%. So I don't take that 10 to 12% very serious. It's because it's a very young company. The stock is very volatile. Now, that story I said about the company has a lot of uncertainty around it. I don't know what the operating margin is going to be in 13 years from today. I'm not sure where the revenue is going to be. These are just estimates. So in order to deal with this uncertainty, I'm building a Monte Carlo simulation. So what it means, I'm going to assume a range around the beta. I'm going to assume a range around revenue growth, a range around equity risk premium, and so on and so on. When I do that, I will let the computer to run 20,000 times. So I do 20,000 DCF models valuation, and this is the distribution I would get. The yellow represent the median, the 50 percentile, the green represent 15, and the 85, the red represent the 85 percentile. If you were going to be unbiased, if you would say, what would the fair price I should pay? Well, I should pay perhaps around the, the fair value, the median, the median of the distribution, which translates to $38 billion in equity market cap. That translates to $30.65 per share in value, which is very close to our base case. Well, no surprise, because I built this Monte Carlo simulation based on my base case and expanding the range around those parameters. Here is my bar chart that represents the correlation between the model variable and equity intrinsic value that we calculated. And here we can see the distribution that I have chosen for the parameters that went to the model. So for instance, the equity risk premium, I picked about 5.8, and with the normal distribution around it, that could be as high as 6.5 or as low as perhaps 5%, but these are very low probable outcomes. Risk-free rate similar, 3% being my base, and 3.4 being highest, 2.6 being the lowest. Same with unlevered beta. The key one that is very important here is the current operating margin. Well, the terminal operating margin. The current is what is really right now, which is about 8%. So I have a low range around it. But as far as the terminal operating margin, I really don't know. I'm not really sure where it's gonna be. I know it's gonna be more than 12%. I think I'm confident that would be the lowest that it will have. 22%, maybe, I don't know. I'm comfortable with 16 and putting this range around it. So I go with a trinomial distribution from 12 to 22. That's the range that I feel comfortable. If anything above that, that's going to be a surprise, in my opinion. The revenue growth rate, again, I start from about 40%, but then could vary. So that's why I deal with the uncertainty about these parameters in the model. On top of that, I build a correlation between these variables. If the revenue growth is high, that's because fulfillment. And if it's because fulfillment, it means the operating margin gonna be low, because we saw the logistic company having lower operating margin. If the revenue growth is high, that's because fulfillment. That means the sales to capital ratio is low. It means the Shopify needs to invest more into the business. Then I also have a parameter in my model, which is additional return on cost of capital in perpetuity. That is me betting that they will take projects that earn higher than the cost of capital. So in order to achieve that, you need to have good management to run the business well enough. That will translate to high operating margin and high sales to capital ratio. So those are the other parameters that I build positive correlation into the model. So with that, that's pretty much it. Thank you very much for listening, and I hope you found this session useful.